Everybody knows that guy, the irritating person at the dinner party who talks about how much money they've made in the markets and how fantastic it's been. What are the couple of rules we can advise on, or a few pointers to make sure you're that person doing the talking? The most obvious, of course, is that if you haven't been in the market, you can't benefit from the market. And too many people are caught up in trying to time the market. There's a wonderful saying that it's about time in the market, not timing the market. And that is so true. Yes, all of us would like to avoid those down days. They make a huge difference to our ultimate return. But in trying to be too clever, we also miss some of those up days. So the basic rule is, if you haven't got a lottery ticket, you ain't going to win the lottery. So get into the market, stay invested in the market. Things have always been volatile. They will continue to be volatile, but you really want to stay involved. How do you get involved? Well, of course, today you can do the free stuff. That means passive investing, and just track the market and benefit from whatever the market does. There's a wonderful advantage to that, in that you're forcing yourself into the gains and losses of the market so that you can get ahead of inflation over time. You could be a little bit cleverer and pay a management fee, or try and pick some stocks yourselves that you think will do better than the market. That's what we call active investing. And ultimately, it's worth paying that fee if you do your homework, if you pick a good advisor or manager who will do better than the market will give you. So where active will do better than passive. Be careful here. A lot of people will promise you better returns, but check their track records. See how they've done through market cycles, the ups and the downs, to see whether it's worth paying them for the type of value that they bring. And talking about value, if you're going to select stocks, try and have a value bias. Look for those companies that are pretty cheap in terms of their earnings and what they will do in the future. That you will find over time should do better than what we call a growth bias. Those stocks that are just flavor of the day, are in a very important trend and an upward trend and doing quite nicely. What we do see is that value over time does better than growth. Remember that you need to buy the company and not the share. So too many people just frequently buy and sell shares as if they're pieces of paper. There really are companies behind these, and you have an ownership into that company. Who's managing that company? What are the prospects for the company? Has management delivered what they said they would do in the past? What is the sector that that company is in? Is it growth, or is it stagnant? Is it commodities? Is it industrial? Is it retail? Is it financials? Remember, you own a piece of that company, and make sure that you'd want to be involved in the type of company you want to be involved in. The other thing, of course, is to check your emotions. Too many times markets go down, everybody panics and starts selling at the worst possible time. It's a strange thing. If you went into a shop and there was a sale, you'd probably be more inclined to go and buy the good because it was cheaper. Why not with investing? Usually what we see is the moment companies go down and things get cheaper, that's exactly when people sell. You need to see or check your emotions, do the right thing. And really what you want to do is buy cheap and sell when they're expensive. It's easily said, it's very hard to be done in reality. One of the points you can do to try and limit any losses and avoid the emotional roller coaster is to diversify. This is really a theory that we've got from many of the very large endowments in the US, which have been incredibly successful over time. And the principle is to diversify, diversify, and diversify some more. You want to own many things, many baskets of opportunity that are uncorrelated with each other. So if some damage occurs to one, hopefully there's a lot of advantage in another. And so that together they're all doing pretty well for you. Even though one of the areas may be suffering, another really would be benefiting in the market environment that we're in. Fees really do matter. Watch what you pay. At the end of the day, it's your money. You want the highest return you can possibly make. The leakage of fees really makes a major difference to your returns over time. How much are you paying for the management of the money? Is there custody fees involved? Are there transactional fees involved? Are there advisory fees involved? All these may seem small at any given year, but over time compound and make a real difference to the return that you want to get. And then finally, be cognizant of tax and the type of structure that you're invested in. One of the major benefits you have is, of course, the retirement funding that's available to you, either through a retirement annuity or your company pension or provident fund, where you can put money away and protect that money from the ravages of tax. All the interest and capital that you're getting there is free of tax, and that's a wonderful gift from the government to allow you to save for your future. Use those effectively. And of course, be very sensitive if it's your voluntary money, money outside of your retirement saving. Every time you trade, there's an implication. There's capital gains tax, or you may even be deemed to be a trader, in which case you start paying at your marginal rate. This can make a real difference at the end of the day to the type of returns that you're getting. You taking the risk, you really should be the one who's getting the benefit.